If this war gets worse, the first country that may be forced to do something drastic is not Iran, it is Japan. And if that sounds strange, good, that means you are finally looking in the right place, because almost everyone covering this crisis is still trapped inside the obvious version of the story. They are staring at tankers, oil fields, missile ranges, the Strait of Hormuz, and gasoline prices. All of that matters, but it is still the surface layer. The deeper layer is this: the Gulf does not only export energy, it also depends on engineered survival. Large parts of the region are held together by desalination. Water is manufactured there the way other societies manufacture steel. Power flows into desalination plants. Desalination flows into distribution systems. Distribution flows into daily life. If that chain is threatened, the crisis stops being about revenue and becomes about endurance. That is the first level. The second level is that high energy stress in the Gulf does not stay in the Gulf. It travels first into the countries that are most exposed to imported fuel, weakest in currency terms, and most constrained in policy terms. Japan checks all three boxes. That is why I think the real story here is not simply oil. It is what I would call the imported crisis trap. A country far from the battlefield imports the consequences of a war it did not start. Then it discovers that every available response creates a second problem bigger than the first. That is where Japan is heading. Start with the basic geometry. Japan has almost no domestic energy cushion worth talking about in a crisis like this. If Gulf instability pushes up crude, Japan pays. If the dollar rallies at the same time, Japan pays more. If the yen weakens while oil keeps rising, Japan is no longer absorbing one shock. It is absorbing a compounded shock. This is how distance lies to people. They hear Tokyo and imagine insulation. In reality, Tokyo may be one of the places where Middle East instability gets translated into policy pain the fastest, because Japan imports fuel, but it also imports pricing pressure through the exchange rate. A weaker yen means every barrel hurts more, every shipment costs more, every policy mistake gets amplified, and every delay starts looking political. Eventually, the government cannot just describe the problem. It has to choose a door. And Japan, S doors are terrible. Door one is to raise rates aggressively enough to support the yen. That sounds conventional. It also sounds clean. But Japan is not operating on a clean balance sheet. It is operating under an enormous public debt burden that turns every meaningful rate move into a fiscal threat. Defending the currency that way risks setting fire to the government. S-own financing structure. Door two is to tolerate a weaker yen and let imported inflation do the damage instead. That means households get squeezed, industry gets squeezed, political legitimacy gets squeezed. A country already conditioned by years of fragile growth suddenly has to explain why living costs keep moving the wrong way while the government appears stuck. Door three is intervention through reserves. That is where America enters the story, because Japan is sitting on one of the largest foreign holdings of US Treasuries on Earth, around $1.2 trillion. In quiet times, people treat that as background data. In stress times, it becomes an option tree, not a guarantee, not an announcement, an option. And in markets, a live option matters even before it is exercised. This is the step a lot of Americans miss. They think a Middle East crisis hurts them only through gas prices. That is far too narrow. A prolonged Gulf shock can trap Japan. A trapped Japan can be pushed toward reserve action. Reserve action can pressure treasuries. Treasury pressure can raise yields across the US system. And once yields rise far enough, the problem no longer belongs to bond traders. It belongs to homeowners, borrowers, businesses, equities, and the federal government itself. That is the imported crisis trap in its full form. A war in one region forces a policy decision in another region that then feeds back into the core pricing structure of the United States. This is why I do not like the lazy formulation that says Japan could sell treasuries and crash everything. That is too crude. The more serious version is more believable. Japan may not want to sell. Japan may not even need to sell much. What matters is the growing possibility that Japanese authorities could feel cornered enough to use the treasury pile as part of a broader defense of financial stability. Once markets start assigning a meaningful probability to that possibility, the repricing begins before the liquidation ever becomes dramatic. And the repricing is the story, because US Treasuries are the floorboards of the global system. If those floorboards start shaking for reasons tied to war, currency stress, and foreign reserve strategy all at once, the aftershocks travel everywhere. Mortgage rates do not ask where the problem started. Credit card rates do not care whether the original trigger was a desalination threat, an oil spike, or a yen intervention rumor. They just move higher. When the base layer of money gets more expensive, that is how geopolitics turns into dinner table economics. But I want to go back to the Middle East for a moment. because this story only works if you understand the first trigger correctly. The first trigger is not merely that oil can go up. Everybody knows that. The first trigger is that Gulf governments depend on infrastructure that is less dramatic than a burning oil terminal, and in some ways more coercive, threaten revenue and governments lose comfort. Threaten water and governments lose control of the clock. They have to respond faster. They feel the crisis sooner. Their populations feel it sooner. That raises the odds that this conflict drags on exactly the wrong way. Not clean escalation, not clean de-escalation, but a grinding stress environment where energy stays expensive, headline risk stays high, and no one gets a decisive resolution quickly enough. That kind of prolonged stress is exactly what Japan cannot afford, because Japan is not just vulnerable to energy, Japan is vulnerable to timing. If oil surges and then collapses a week later, Tokyo can manage around it. If oil stays high while the yen stays weak, the trap closes slowly and publicly. Each additional week turns more commentators into intervention speculators. Each additional move toward politically intolerable exchange. Rate levels raises the pressure on officials to prove they still have agency. And when governments feel they must prove agency, markets get volatile fast. Now add the second shadow hanging over the story. The yen is not just Japan's problem. It has been part of global risk architecture for years. Cheap yen funding helped support carry trades and leverage positions across markets. So if a Gulf shock destabilizes the yen at the same time Treasury yields are rising and risk assets are wobbling, you do not get one isolated event. You get interacting stress. That is what makes this so dangerous. Energy stress, currency stress, reserve, intervention risk, carry trade instability, Treasury repricing, growth slowdown. These are not six stories. They are six stations on the same line. And I think the deepest mistake in current coverage is that it still treats Japan as a side character. Japan is not a side character in this setup. Japan is the transmission point. It is the place where Gulf stress gets converted into a potential shock for the most important bond market in the world. That is why I would pay close attention to language coming out of Tokyo. Not just the numeric levels in the yen language, because governments usually tell you where the pressure is before they tell you what they're going to do about it. When phrases like all necessary measures, excessive moves, disorderly markets, or stability action begin appearing more frequently and more sharply, they are not performing for television. They are preparing the market psychologically for the possibility that intervention is coming. And once intervention becomes credible, every treasury trader, every macro fund, every risk manager in the world starts running the same mental calculation. How much selling could Japan do if forced? How fast could the market absorb it? What yield levels become politically uncomfortable in Washington? What breaks first if those levels are reached? That is the point where this story stops feeling foreign. Because now the question is not what happens in the Strait of Hormuz. The question is what happens to the price of American money if one of its biggest foreign creditors starts acting under duress. And once you ask that question, you can see why this is such a delicate moment for the United States. Washington would prefer to treat the crisis as something manageable through military pressure, shipping strategy, and selective energy adjustments. But the system is bigger than the battlefield. The longer the conflict keeps transmitting into markets, the more Washington has to care about the response of allies who are not on the front line but are carrying the financial aftershocks. Japan is at the top of that list. There is also a brutal political irony here. Japan is America's ally. The stronger the dollar panic gets, the more that alliance can become a transmission channel for stress rather than a shield from it. The United States is supposed to be protected by demand for treasuries, but in this kind of environment, one of its closest partners could end up being pressured by circumstances into turning that protection into leverage, not as an act of hostility, as an act of necessity. That distinction matters a lot. Hostile liquidation would be easier to understand. Necessity driven selling is harder because nobody intends to trigger the broader consequences. They are just trying to survive their own corner of the map. But markets do not care about intentions. They price flows, probabilities, and stress. So what should you watch if you want to know whether this risk is graduating from theory into danger? Watch whether Gulf infrastructure threats begin sounding more like endurance threats than energy threats. Watch whether crude stays elevated long enough to become embedded rather than shocking. Watch whether the yen approaches levels Tokyo cannot politically tolerate. Watch whether Japanese officials sound less patient and more boxed in. Watch whether U.S. yields begin moving in a way that suggests somebody large somewhere is preparing for a world in which reserve selling is no longer unthinkable. And above all, watch whether people keep talking as if this is still just an oil story, because that is how, they are behind. The headline says Middle East, the deeper story says Japan, and the deepest story says that when a distant ally is forced into an imported crisis trap, the final bill may be paid in the treasury market, the mortgage market, and the American economy that is the line I would keep in front of me. Not because it is guaranteed, because it is the kind of risk that stays ignored right up until the moment it becomes obvious to everyone at once.